Good day and welcome to the question clip on chapter 4, and we're dealing with inventory. The question that we're going to deal with is question 4.21, and it actually consists of 3 sections. We're going to deal with each section separately. And let's start by reading the required part for section A. They ask us to advise pick a book on which of the 2 methods used to allocate cost to inventory, either first in, first out, so that's our method number 1, or then the weighted average method, method number 2, will yield the highest gross profit for the entity. To calculate a gross profit, they tell us to use a trading statement to support your answer. So the first thing that we have to do is get our framework ready to calculate a trading statement. A trading statement starts off with sales minus cost of sales, and cost of sales can be a calculation of the opening inventory plus the net purchases minus the closing inventory. And this sales minus cost of sales will then give us our gross profit, which we can compare then between first in, first out and weighted average. Remember, in the trading statement, the net sales and the net purchases, they are calculations in their own right. Net sales will be sales minus sales returns minus settlement discount granted, and the purchases will be purchases minus purchase returns minus settlement discount received. So just keep that in mind when you're drawing up your trading statement format so that you can apply that when you do your calculations. Look out for those entries. Okay, Pick a Book has the following information available in their inventory system. They give us a few dates with opening inventory, cash or credit purchases, and then they give us for the same period of time the total sales, and they give this information both in units and in cost. Remember, when we do our accounting entries in the trading statement, we work with the cost. So if we start by earning marks for the amounts that was given in the table above, for first in, first out, the sales will stay the same for both inventory valuation methods. And they didn't mention any sales returns. You'll see, or any settlement discount, so we can just include the sales there. Then our opening inventory also remained unchanged at 2,080 Rand for both the inventory valuation methods. The same for purchases. So for the purchases, we will just take all of these cash and credit purchases. So it will be the total of all 4 of these amounts added together, amounting to 3,300 Rand. And now when we have to calculate the closing inventory, that's where the difference will come in. Because for first in, first out, whatever inventory came in first went out first. So we will have a different inventory valuation using first in, first out versus weighted average, because for weighted average, we apply a certain formula to get to the price per unit. Now, step 1 for both of these inventory valuation methods is to calculate the number of units. The number of units won't change between the 2, but remember that number of units has to be multiplied with a specific price per unit. And this price per unit is influenced by the inventory valuation method, either first in, first out, or weighted average. If we then look at the number of units of closing inventory, the number of units that we started out with, our opening inventory, so we had them to sell during this period from the start. So if we start with the opening inventory of 80 units, and we add to that all our purchased units. So we purchased 20 plus 30 plus 50 plus another 20. So if you add the 80 plus all the purchased units, which will add up to 120 units, we get to 200 units available between opening and purchases. opening inventory and purchases. Of this 200 available units, we sold 140 units during the same period. So if we deduct that 140 units from the 200s, the units that we had left at the end of the year is 60 units. We now need to look at this 60 units and multiply it with a price per unit. First for the first in, first out method, and then for the weighted average method. Now for first in, first out, if you look at the units available, whatever came in first went out first. That means that these top units were the units that we sold first. If we are now looking for 60 units as closing inventory, we have to start by looking at the last batches. So if I look at the last batch, I find of the 60, 20 units is from the last batch. So I would have to split up my 60 units that I've calculated into 20 units from the last batch. And then to get to the 60 units, I need another 40. That 40 will be taken from the second last batch. So I found the 20, and of that 50, I only need to take 40 units. So my 60 units consist of 20 from the last batch and 40 from the second last batch. Each of these will now have to be multiplied with a price per unit, and the price per unit, if you take your total cost divided by total number of units, that gives you a price for one of those units. So for the last batch, to get to the price per unit, I take the total price of 520 and I divide it by the total number of units. For the 40, I need to get to a price for one of those units, which is the second last batch. So it's the total divided by the total number of units to get to the price for only one of those units. So that will be my 1,350 divided by the 50 units. If we do this calculation, we get to a value for our closing inventory if we applied the first in, first out method of 1,600 Rand. I can now complete my trading statement for first in, first out by including the 1,600. My cost of sales is my opening inventory plus my purchases minus the closing inventory. So I have a cost of sales of 3,780, and then sales minus cost of sales will give me 3,000. Sales minus the cost of sales of 3,780 will give me a gross profit of 1,540. So step 1 for first in, first out was to calculate the number of units, and then we assigned a price per unit according to the batches. Step 1 for weighted average stays the same, so I can just use this 60 units, and now I have to get to a price per unit for weighted average. Weighted average, like the term explains, is an average price per unit. So my formula for the price per unit is the total value of available units divided by the total number of available units. So if we look at the given information, I need to get to the total value of available units. Total value is the value of the opening inventory plus all the purchases. And if I add up that total value, it gives me 5,380 Rand divided by total number of available units, which adds up to 200 units. We've already used that amount earlier in the question. So my price per unit for weighted average will be 26.90. Total value divided by total number. If I now multiply the 60 units that we calculated in step 1 at the top already, the new value for closing inventory is 1,614. So this 1,614, when entered into my trading statement, will give me a cost of sales of 3,766 Rand and a gross profit of 1,554. So now we can compare whether first in, first out or weighted average will give you the highest gross profit, and clearly we have to recommend the weighted average method. That was section A. In section B, the owner of Pick-a-Book became aware that the store manager is stealing inventory from the store. Pick-a-Book needs to calculate the quantity and cost of the inventory stolen for insurance purposes. In some of these insurance questions, they tell you to make use of a trading statement, but in this section B, they ask us to prepare an inventory account. So now we can't use the trading statement, we have to use the inventory account to determine the cost and the quantity of the inventory stolen. Remember, if we want to calculate a loss, we always compare our theoretical inventory with the actual inventory. So what we are going to calculate in the inventory account is the inventory according to theoretical bookkeeping. The following information is available for the period 1st of September to 31 December. So if we take this information, they give us the actual inventory on hand on the 1st of September 20.8. We start off our inventory account. With the balance provided, the 28,000. So I'm going to start off in my inventory account with the balance of 28,000. Then they mention credit purchases in units as well as in cost, and I use the cost to account for the purchases in my inventory account. So on the debit side, I will increase my inventory with 170,000, and that was credit purchases, so it's creditors control. Then they mention total normal credit sales of 102,638. Now remember, we are preparing an inventory account. And in the inventory account, we do not apply the selling price ever. We work with a cost price. So this credit sales of 102,638 has to be converted to a cost price first. In number 1, they mention that the entity uses a weighted average method to calculate cost to inventory, and the perpetual inventory system is used to record transactions of inventory. That's why we're able to draw up an inventory account. And now the entity marks their inventory up at 15% on cost. Now, if they give you a profit markup on cost, if we work with our 3 concepts, cost price, profit, and selling price, if it's on cost, the cost will be 100, the profit is then 15, and the selling price will be 115. If they provided me with a selling price of 102 and I want to convert that to a cost price, it's what I want. I want the cost divided by what I was given. I was given a selling price of 115. So to convert that 102 into a cost price, I multiply with 100 and I divide it by 115. And that will give me my decrease in inventory on the credit side of 89,250. So I keep track of the inventory in the inventory account at cost price, increases and decreases. Then they give me a gross loss on the special cash sales. Now this is a special arrangement, so my profit markup of 15% on cost is now not valid anymore. They tell me in November 20.8, there was a special cash sale to get rid of the old books. Inventory was sold for 10% less than cost. So now my cost is still the basis of 100, but the markup is a loss of 10 below the cost price, leaving me with, I got rid of it for a selling price of 90% now. This amount that they provide me with, the 4,250, is the loss. So that's what I was given. So if I want the cost of that, I want the 100, so I multiply it with 100, divided by, I was given the loss. So I was given only the 10%. So the 4,250 multiplied with 100 over 10 will now give me the cost price of the special sales. And that will make my inventory decrease on the credit side, 42,500 cost of sales. Good. Then we have carriage on purchases of 6,000 Rand. Now, if you can recall the theory for inventory, a cost is calculated by not only the purchase price, but the purchase price plus any expenses to get the inventory to a location and condition ready for sale. So that 6,000 Rand will be added to the purchase price, and for perpetual inventory system, we do all the adding in the inventory account itself. So I'm going to add on the debit side the 6,000 Rand for bank, which is my carriage on purchases. Then they mention that we issued credit notes. Now you'll recall that from chapter 4 of FRK 111, credit notes are for returns. So it's either us returning to our suppliers or the debtors return to us. If we issue the credit note, that means that they return to us. The debtors return to us. So it's a sale returned. Sales returns will make your inventory increase. We'll have to add that on the debit side, but we can't work with a selling price. Remember the credit note, if you return something, you will still not be aware of the cost price. So this 4,399 represents a selling price. So I have to convert that to a cost price. And that will be added back into my inventory. On the debit side, if it was a cost of sales corresponding debit for a sales transaction, a sale return is just the opposite of that, so it's cost of sales on the debit side as well, 3,825. At this point, we are done with all the accounting entries. We made use of that. Returns were only allowed on normal sales. That's why I used the normal gross profit percentage at the top there. In my inventory account, I'm now ready to calculate my theoretical balance for inventory, 76,075. That's what I say in theory we should have for inventory. If they then tell me that actual, remember we want to compare our theoretical inventory with our actual. Actually, at the end of the year, we still had 650 units left. To be able to compare my theoretical inventory with my actual inventory, I will have to calculate the cost of the actual inventory. They told me that I use the weighted average. So for weighted average, the 650 units was given. That was step 1, you remember, for weighted average. But now I have to multiply it with a price per unit. That price per unit cost is the purchase price. So it's my opening inventory plus my purchases, plus any other expenses to get it ready for sale. So total value of available units divided by total number of available units. And this 400 and the 2,000 is the 400 opening inventory plus the 2,000 credit purchases. So that's how they calculated the price per unit of 85 Rand. And if I take that 650 units, multiply it with the 85 Rand, I get to my actual inventory on hand. Now, in theory, from the T account, we estimated inventory to be worth 76,000. That 76,000, when compared to the actual inventory, there was a decrease from theoretical to actual. That's the amount that was stolen, 20,825. Then if we can carry on to section C, the very last part. Due to Harry Potter books coming out soon after the entity's year end, the owner of Pick a Book is expecting a decline in the demand for the current books in the store. He is estimating that the selling price for all the books will have to be adjusted to 86 Rand per book. He has estimated that the cost to transport the books to the different branches of Pick a Book will amount to 2 Rand per book, and the advertising cost to 1 Rand per book. When we get to the inventory valuation in the statement of financial position, like it is required here, the rule that we apply is the net realizable value rule. If the net realizable value, what you can sell it for minus the expenses, if the net realizable value drops below the cost, and we just calculated the cost of the inventory at the top there, if it drops below the cost, then we will have to adjust the cost to the net realizable value. The cost of the actual closing inventory was calculated as 55,250. Remember, we got that from the 650 units at 85 Rand per unit. And then if we compare that, the same 650 units, but now at net realizable value. Net realizable value is the selling price minus any expenses related to the selling price. If I then get a net realizable value of only 53,950, I have to adjust my cost to get it to net realizable value. So I will need an adjustment of the difference between the two, and the inventory figure in the statement of financial position will then be the lowest of the two, which is the net realizable value. I hope that you found this information of use, and I hope to see you again later.